Good morning to those of you joining us in the West Coast, and good afternoon to those in the East Coast. Welcome to today's panel discussion, which is the final installment of RSM's Business Essentials series for the year, and it's also the focus of our latest Think Big report titled Business Survival Strategies in Challenging Times. Firstly, I'd like to begin today by acknowledging the Gadigal people of the Eora Nation, the traditional custodians of the land on which I'm facilitating this webinar from. I'd like to also acknowledge the traditional custodians of the various lands all of you are joining from, and pay my respects to the elders past, present, and emerging. My name is Arlene Cristianto. I'm one of the partners at RSM Australia, and I am privileged to be facilitating our panel discussion today. Combination of events that's been playing out for the past several years have certainly left a lot of business owners frustrated, confused, and worried. The current environment, both economic and geopolitical, requires every business owner to be prepared and proactive, no longer let's wait to see what happens or hoping for the best. So I'm thrilled today to be joined by a panel of experts who bring a wealth of experience across various aspects of business health. And together we'll dive into insights on cash flow planning, business health checks, and other essential indicators that can help a business on track. Our goal today is really to equip you with actionable advice to recognize and address red flags before they become obstacles. So today I have my colleagues Gavin, Stacey, and Nick Farr, who are experienced advisors to private and family-owned businesses, providing support and advice on virtually every aspect of the business lifecycle, including business strategy, financial management, and structuring. Also joining us, Andrew Boucher and Shannon O'Connor, who have decades of experience on all facets of business turnaround, restructuring, and administration, constantly speaking to clients about ways to alleviate the pressures of debt difficulties. So welcome to the panelists. For those joining in the call, if you have questions, please pop them in the chat box. I'll monitor those and we'll answer them as we go along. If we have time, we'll also allow some questions at the end as well for some final questions. So, Gavin, I might get you to kick us off. And probably if you can just share a little bit about, from what you've seen in your experience, what are some of the most common financial indicators that might suggest business is heading towards some trouble?
Yeah. Thanks for the intro, Arlene. I guess some of the most common financial indicators generally revolves around cash flow issues. These are the earliest indicators that we can really spot to. It's the old adage, cash is king, is real. So really looking at monitoring your bank balance, if that's trending on a decline and you're not maintaining a sufficient working capital balance, it's a pretty obvious indicator that there might be some difficulties on the horizon. And then having a look at your customers and your suppliers. So growing creditor days, if you're taking longer to pay your bills, you're trying to hold on to that cash, that's generally a sign that we're operating out of general business terms. Or on the other side of the coin, if your customers are not paying on time and you're struggling to collect from your customers, that puts added pressure on your business and your customers' cash flow issues and worries might be impacting your own. So couple of key things there from your day-to-day perspective. I guess from an advisor side, something that's really easy for us to see is ATO debt and outstanding ATO lodgements. It's generally a bit of a red flag that there might be some issues there if we've got a growing ATO debt and if clients or businesses aren't keen to get on top of it, or they're looking at their outstanding lodgements and not really getting on top of these and almost putting their head in the sand. So that's really on the cash flow side, and they're kind of some of the easier things to see on the surface level. Then if you dig a little bit deeper, you have a look at business performance issues and general profitability. So we're currently experiencing inflationary pressures, growing labour costs and the like. So if businesses aren't passing those increased costs on, there might be some pressures on your margins dropping, or if we try to pass those on, we might be losing customers due to competitive tension or the like. So really having a look firstly at that cash flow, those short-term indicators that there might be some dramas, and then business performance as a whole, and ensuring that you're still maintaining the profitability required to make your business successful.
And Nick, is that sort of the things that you're seeing as well with clients, with businesses that you deal with? How do you then distinguish between, is this only a temporary issue, or is it actually more of a serious financial distress?
Yeah, thanks, Eileen. Look, I think that the key feature that we often see from clients when differentiating between a temporary cash flow shortfall and a business that's more heading towards that financial distress is just the frequency of which the cash flow shortfalls arise. Is it a recurring issue or just a once-off shortage that wasn't maybe planned for? Usually we'll define a once-off shortfall as something that can be explained. It might be that you had to outlay for a large capital expense that you just couldn't get financing for at the time. Have you been making some redundancies and the payouts all fell due at once? So you're buying out a shareholder. We all know interest rates are rising. Has that kind of hit your bottom line? Or have you had interest-only loans swapped to principal and interest payments? Ideally these are things that you can plan for, but we appreciate it's not always the case. So if you do get caught off, once in a bad situation that you can trade through, we'd very much consider that a temporary issue. Where a shortfall, is repetitive and a constant point of strain on a business's cash flow, is it every quarter that your super falls due or your BASs fall due or payroll tax falls due? We'd probably consider that a bit more of a serious issue. The question that we kind of get from clients is then what can we do about that if it is of a repetitive nature? We find a good place to start is a good review of a budget. Often people are underestimating what their outflows are. They account for the known quantums, but it's all those little extra bits and pieces that seem to get them in a pinch. If the budget is okay, but cash flow is still poor, I guess touching on Gavin's point earlier, your cash flow and your profitability don't necessarily go hand in hand throughout the year. So it might be time to start looking at a three-way forecast just to see how long you can sustain your current trajectory. And we've found it's often less than you think. We had an instance with a client where we prepared a three-way forecast. They thought they had 12 months left to go. It turned out they had 3. So I think it's important to actually go through that exercise if you are hitting these recurring shortfalls in your working capital. So I think coming back to the core of the question, it's just how often do you find yourself short on cash? Is it something that's one-off and explainable, or is it every quarter? Is it every month? And then you might have more of a serious issue.
I'm getting the sense that sort of, I guess, timing, planning, and also that monitoring is very important for businesses and business owners. And we'll touch on timing as well a little bit, but I just want to build on kind of just some indicators for businesses to identify. Shannon, from your perspective, what sort of behavioral signs do you see from business owners that would indicate they might need the help?
Thanks, Eileen. So we normally, in a restructuring recovery side of things, we're normally looking retrospectively and looking back and kind of seeing what the signs were. So we have a good touch point of what is commonplace with businesses in financial distress. So one of the key signs to look out for is a noticeable change in the business owner's emotional behaviour. This could manifest in something like a loss of motivation, isolating themselves, or frequent absences from the business. It could also result in the breakdown of personal relationships, as well as relationships within the business itself. So between directors or even with employees, key customers, suppliers, and financiers. Relationship breakdowns can be a sign that the stress of running a business is taking its toll and can further impact the business's performance and its owner's well-being. Business owners may make financial decisions within the business itself or personally that can indicate a business is in financial distress. Again, this manifests itself in a change in behaviour, but financial in nature. These may include increasing concerns, noticeable concern about cash flow or the business's future, applying out of the ordinary discounts to services or products. So while seasonal or occasional sales may be normal to a business, the persistent discounting may indicate that a business is struggling to attract customers or maintain its revenue targets. Staff redundancies. So reducing staff numbers can be a significant sign that a business owner is facing difficulties. This step, if done without the appropriate advice, can have a profound impact on the business's operations and staff morale. Downsizing the business. So downsizing, whether it's reducing the physical space or scaling back operations, is another indicator that a business may be under financial strain. This move is usually aimed at reducing overheads, but can signal deeper issues. And I find the most critical one of all is selling down personal assets and injecting personal funds into the business and increasing that frequency of the personal funds being injected. Doing this to keep the business afloat is a clear sign that a business is in financial distress and may also have severe consequences for that owner's own financial circumstances. While this behaviour shows commitment, it can also highlight the actual severity of the situation. These behavioural shifts may mean a business is in financial distress, but there also may be other reasons. But looking at all of them and trying to understand with the commentary that Gavin and Nick have made, it's a timely reminder to take a step back and work on the business and seek advice where needed. If business owners are considering these out of the ordinary measures, they should really be seeking advice prior to doing so to make sure it fits in with their business and the future of that business.
I might just build on that your comments as well there, Shannon. And Andrew, what are you seeing in terms of early signs that businesses are accumulating too much debt?
Thanks, Arlene. Look, in many ways, there probably isn't a one-size-fits-all, but some of the indicators which we can see is that the business itself might be struggling to make their existing loan repayments, and as Gavin said previously, is a lot of the business loans are now going from interest only to principal and interest. We're also probably seeing where a lot of times there's a bit of a shift at the moment with clients where they're using off-balance sheet finance. So in other words, they, for an example, in the agri sector, they may be using merchandise accounts like Elders and people like that, or using fertiliser producers like Pivot to actually borrow funds to actually shore up their balance sheet and still deliver inputs, but at the same time to not doing the traditional finance, i.e. through their banks. Or we're also seeing probably in many ways too, if a business is accumulating too much debt, one of the signs is the ATO a lot of times they're using the ATO as their quasi banker. So you see where the ATO debt's going up, and at the same time too, it's not being dealt with, and they might still be honouring their creditor payments and things like that. I think the other thing, which is probably, in summary, it can be a lot of these different things which can have a impact on a business, and at the same time too, that creeps up on them, and it's not uncommon where a business just one day says, oh, I didn't realise that we've now accrued so much debt in our balance sheet. So one of the more important things is that they should be talking to their advisors regularly and doing a financial health check to make sure that they're not in that position where it just creeps up over a period of time.
Thanks, Andrew. I've got a question here from the attendees, and I'll probably refer back to either Gavin or Nick, because I think it's one of the points that you raised before. Sometimes, costs are being passed on to customers or consumers, but that would contribute to inflationary pressures. What other alternatives can businesses consider? Should they absorb some of these costs, accept slightly reduced profit, rather than adding more into inflation? Gavin, Nick?
Yeah. I think the business owners have to make these decisions, right? And really the critical aspect is being aware of what your margins are, being aware that if your costs are increasing, making the decision as to whether to pass that on to the customer or wear it and the impacts that'll have on your profitability. The key issue is if you're not aware of it, and your costs just are gradually increasing along the way, and you're not reacting to the changes in the market. And if you're running a high quantity, low margin kind of game, then that can have critical impacts on your business viability. So it is your decision as a business owner of whether to pass that on or wear some of it. Just make sure it's a decision in your control and you don't find out too late that your margins have contracted too far.
Yeah, I think further to that, from what Gavin just said as well, and we find this with a lot of our clients, is just asking, when did you actually last increase your prices? A lot of small, medium businesses, they set their pricing once, and then whilst, and Gavin said, keep track of your margins, their wages increase, their freight increases, their inputs increase, but they still 5 years, 10 years later haven't actually adjusted their prices for anything. That doesn't need to be a knee-jerk reaction to inflationary costs, but just being aware where your margins are and, is it time to review your pricing structure?
I think it makes a lot of sense, and that kind of emphasizes, I guess, what we were talking about before around the timing, the planning, and monitoring. The timing seems to be pretty key as well, and you guys would have encountered many scenarios where the outcome would have been much better, or there'll be a lot more option if the help was so early. When should businesses or business owners then seek advice?
Probably goes without saying that the earlier you engage with advisors, and the better. I've seen too many examples of people like putting their head in the sand when things aren't going well, really entrench themselves in working in the business rather than on the business, which means by the time they actually get an external party involved, or they ask their accountant if they see them once a year to do tax returns or the like, it's often too late if there were some critical factors impacting their business. And the later in the piece, the more practical options that fall off the table. I think at the end of the day, the best time is to fix a leaky roof is when the sun's shining. People generally reach out for help when it's probably too late. But if you're having these conversations on a routine basis with your advisors as frequently as possible, you're asking the right questions, it allows you to be more agile, make real-time decisions, ties back into that planning and what Nick touched on, the three-way forecast with our cash flow, profit, balance sheet. If we're reviewing those on an ongoing basis, these short-term issues don't become catastrophic issues to your business. And we just have so many more options, whether we're restructuring, whether we want to sell a underperforming asset or whatnot. But if we just put our head in the sand, these options tend to fall away.
And there are some misconceptions out there, isn't there, about businesses when they are in financial difficulties? And again, coming back to the timing, how do you guys suggest that we address these earlier on?
Yeah, look, I think just following on from what Gavin said, doing nothing these days is no longer a strategy. Although we've come out of a period of uncertainty post-COVID, there have been a lot of, I guess, leeways afforded to businesses, whether that's through the banks not really taking any action in the last 4 years, where people might be deviating outside of their borrowing terms. An example that we've had recently when talking to a bank is, if you come to a bank early with some cash flow shortfalls in the future forecasted out, and you need to extend your working capital facility, they're more likely to come to the table. If that debt's already crystallized with the ATO, their credit team just sees refinancing ATO debt, which they just won't touch these days. To that, and Andrew already spoke about it, you can't just use the ATO as your overdraft account. They're being more active than we've ever seen in terms of outstanding debts. Also on the SGC side of things, for your super guarantee, as soon as a payment is made late, you'll get a letter from the ATO with the please explain you can't lean on your employee entitlements. And I guess the the old one of if I don't lodge, they won't know the debt. That doesn't really work anymore. A lot of the labels on your activity statements are coming through from STP data. They know it's there, and again, they're being more vigilant on kind of latent non-lodges. Sometimes we find that businesses that are in this state, whether external or internal factors, they won't be able to trade out of that position unless there is some utilization of the tools and options available. And not to steal the thunder from my R&R colleagues, but engaging with them doesn't have to be terminal. It can be a form of treatment if acted on early enough. We had another example with a client, bad circumstances throughout COVID, tried to trade through it, just didn't fully ever recover, and then actually went into a voluntary administration process and identified that they had a business unit that, whilst was profitable, it was just too much of a strain on their cash flow. So going into that VA process and selling that business unit out of the business allowed them to lean down, pay down debts, and now they're actually still trading as a result. So I think you can't rely on what you potentially have been doing the past 4 years. And there are tools available and options available that aren't just liquidation, that there's other avenues.
And you have stolen my thunder too, Nick, because that was going to be my question to our R&R colleagues. Because yeah, it doesn't have to be, as much as we've been talking about, businesses that might be facing some financial difficulties, getting the right advice early is generally your best bet. So yeah, actually getting some insights from Andrew and Shannon on what are the typical options that are available for businesses. And to Nick's point previously, they're actually, they're proactive options as opposed to that's it, that's the end of the line. So I'm happy for, Andrew or Shannon, either of you guys give us some insights there.
Maybe before we go into some options, Arlene, I think it's probably important to say that, and again, you've taken my thunder a little bit, which is great, is that it's not a bad thing to actually talk, and it's not a bad thing to seek advice from different people. And our specialty in R&R, or reconstruction and recovery, is to actually help people. And just because you're talking to us doesn't mean it's going to be terminal. It doesn't mean that there's no point of no return. There is always options. And obviously, as Gavin and Nick have said, the more proactive and the more people actually seek that advice, the greater chance you have more options. And I think the great thing we have, if we can do a plug for RSM, is that we're a multidisciplinary practice. So we can actually pull in different people with different skills and expertise when the time arises. And quite often in workarounds and recovery matters, we work with external accountants, we work with internal tax specialists, auditors, and the list just goes on, because you need to get all those resources actually there when the time is needed. And I think that the hardest thing most people have is to ask, to stick their hand up and say, look, I may have a problem. Can you help me? And I think that's really, really, if that's a segue you can take away today, is don't be afraid to ask. And I think I'll go a little bit quiet now and sort of throw over to Shannon. But Shannon might cover off about if you're an individual, and then I can talk about if you're a corporate entity.
Great, thanks, Andrew. So yeah, my specialty within RSM is personal insolvency. It's one of the main areas that I work in. So I'm often working with individuals, understanding their options, and then working with them, whether that be by formal appointment or consulting and assisting them liaise with their creditors and reach an agreement. So I wanted to talk through the main three types of formal personal insolvency appointments. They're debt agreements, personal insolvency agreements, and bankruptcy. Now, people see these and there's a big stigma attached to them, but there are some benefits of entering into one of these formal appointments. It provides certainty and draws a line in the sand, allowing the individual to have a fresh start. Although it's a huge decision to make, we often see a marked improvement in the emotional and financial well-being of that individual once they have made the step. Quite often see them come back, months down the track and say to us, I should have done this early. The first one is debt agreements. So debt agreements is an agreement between a debtor and creditors. It's a flexible way to come to an arrangement to settle debts without becoming bankrupt. Usually it's a percentage of the combined debt over time. Debt agreements are smaller in nature. There are limits, the amount of assets, debt, and income a debtor can have to be able to put forward a debt agreement. These limits are currently around 287,000 for assets, 143,000 for debts, and 107,000 for after-tax income. Debt agreements generally last for up to 3 years. The second one, and it's probably my favourite one that I enjoy doing the most, is something called personal insolvency agreement, or a PIA. This is where a proposal, it's a legally binding agreement. It's also the debtor themselves puts forward a proposal to their creditors. There's no eligibility limits on assets, debt, and income. A controlling trustee is appointed. They assess the proposal, they look at the debtor's financial affairs, and they put forward a recommendation to creditors. There's real flexibility as to what assets a debtor can include in this proposal, but it'll usually need to result in a better outcome for creditors than they would receive in bankruptcy. So the proposal itself may be a one-off lump sum payment from a family member or a friend, installments over time, sale of specific assets, or a combination thereof. It's really down to the debtor's discretion as to how they see the proposal looking. In the proposal, a debtor may choose to retain assets that they would otherwise have to include in bankruptcy. The main one in this is the family home, and this is a key reason why individuals do choose a PIA over bankruptcy. If creditors approve the proposal, then the agreement is documented by way of a deed. Once the debtor has complied with their obligations under the deed and creditors have received their distribution, the PIA is finalised and the debtor is released from their debts. So we often work with debtors in understanding their specific circumstances and desires and in formulating the appropriate proposal to creditors, ensuring it has the best chance of being accepted. So one of the examples I've had recently is with a debtor whose main goal, like I said before, was to keep the family home. So they had structured their proposal that the family home itself stayed outside of the proposal and the joint assets of the family, all the rest, were pulled into the proposal. That meant that creditors, which is mostly the ATO, got more cents in the dollar that they accepted, but it also on the flip side meant that the debtor and his family got to stay in and keep that family home, and it was protected from being used to pay creditors. The final option is bankruptcy. Someone can be made bankrupt either voluntarily or via creditor's petition, and a trustee is appointed. So there's a few main areas that a trustee is doing. They're realising vested assets, they're conducting investigations, they're assessing any income and income contributions payable, and distributing any funds available to creditors. To summarise bankruptcy, it normally lasts 3 years. Most debts are provable and extinguished. Common exceptions to this are child support and study loans. Most personal property is realised in bankruptcy. Main exceptions are tools of trade up to a certain limit, motor vehicles up to a certain limit, and superannuation. Now, in this instance, like I said, the family home is normally up to the bankrupt's interest, will be realised as part of the estate, but something a trustee would normally do, and this is something we do at RSM, is we will reach out to the co-owner or the family members first and give them that first option to acquire the estate's interest. So that's giving that individual and that family the best chance possible in the circumstance of retaining the home. It's a little more complicated than a PIA, as there are some, you'll enter into a sale agreement or a deed, but it's still an option there that's available, and it's conversations we would have with an individual prior to them going bankrupt so they understand the potential process moving forward. Lastly, in terms of bankruptcy, if an individual's after-tax income is above the limit, which is currently 72,000 with no dependents, then they are required to pay 50% to their estate. So I know a common misconception with individuals is when they're going bankrupt is they can't earn over that limit. That's not what the limit is there for. That limit is what you can earn before you pay income contributions. So we encourage people to go out there while bankrupt and earn as much as they can, because for that 50 cents of after-tax income they're paying to their estate, they're also getting the benefit of that additional 50 cents. So it's a misconception that we try and appease people of to make sure that they're earning and working through bankruptcy to make sure on the other side they're building up their own wealth again moving forward. That's a summary of the personal side of things. I'll flip back over to Andrew to discuss the corporate side.
Thanks, Shannon. And I just, before we sort of start talking about, and I'll define what corporate is, just so people are aware, if you sort of watch American movies and things, you'll hear the word bankruptcy being used for, companies and things like that. In Australia, because we're under a Commonwealth jurisdiction, an English system, what that means is that you go, bankruptcy is a term for an individual. It's not a term for a company or anything. And I just thought I'd explain that, because quite often people will come and see you and say, my company needs to go bankrupt, and there's no such sort of terminology or process in Australia for that. So I just thought I'll define that. When we talk about corporate, we're talking about a company or a corporate trustee of a trust. So in other words, a non-individual or a non-partnership. And there's sort of two general areas you can look at, is an informal and then a formal. And I might just talk about informal. And an informal area might be is that you have a business and it is under some form of financial pressure, or it's not trending very well. And one of the options we can look at is it need what we call a formal appointment, which I'll talk about in a minute, or is there some informal things we can do, i.e., is it able to rearrange debt? Is there the ability to maybe close down a certain business line or a branch office of the business, and even though they may have to pay redundancy payments or other things, they can still afford to do that without going into some form of formal insolvency type of appointment, because they're able to trade their way out of. A lot of times too, we look at things like payment plans and whether assets can be refinanced or sold, or just or a part of the business might even be looked at being either sold on as well. And the reason we just want to talk about that is a lot of times when someone may be trending or who's under some form of financial pressure, they may not have thought about all the options. So it's just good to just throw any option out there just to work with their advisors. From a formal point of view, and we're talking about here, as I said, companies or corporate companies which are corporate trustees of a trust, is that obviously if they're solvent, you have a thing called a member's voluntary liquidation. And what a solvency is that meaning that it can pay its debts as or when they become due in the next 12 months. So in other words, it might be for an example, a company which might have been a land holding company for a farm. It's surplus now. The farm's been either sold or transferred with some intergenerational transfer, and the company's just sitting there, and we liquidate that under what we call a member's voluntary liquidation. So in other words, it's not insolvent. And you might say, well, why should we liquidate it? Well, and liquidation has this very negative finite term, but working with the tax advisors and the business advisors, it might be more tax advantageous to actually do that form of liquidation to pay out the retained earnings or the director's loans or other things which are in the company. So it's a tool which can be quite good for succession planning and for tax purposes. Obviously, if an entity isn't solvent, meaning that it probably can't pay its debts as or when they fall due or in the next 12 months, there are things like what we call a creditor's voluntary liquidation. So in other words, what that is that the directors say, or the director says, look, I don't think we can pay our debts. And at the same time too, the shareholders then confirm that, because the shareholders may be different to the director. And then it goes to creditors, and there's a process there, and there's investigations. And it's not dissimilar from what Shannon was talking about as an individual when they go bankrupt. So a creditor's voluntary liquidation is a process of the company going bankrupt, even though we're not allowed to use that word bankrupt. So, and then there's another process which Nick talked about, which is a thing called voluntary administration. And a voluntary administration has very set time frames, it has very set requirements, but it could be a process where the company needs to either do an arrangement with the creditors to ultimately trade on, and obviously the creditors need to approve it, but it might be that certain, if I touch on Nick's example, is that there might be hypothetically 4 different business units, one's not performing well, they shut that down, sell another one and keep the other 2. The creditors agree to that, but under what we call a deed of company arrangement, the creditors agree that these are the rules and this is what's going to happen during the process. And it gives the company time to put those things in place. So in other words, they can make an arrangement to pay so many cents on the dollar to creditors over a period of time and still continue trading, or they might have to give them time to do a restructure. And the reason why that is appealing is the business can still continue, and at the same time too, creditors will get a greater return than if it was to go into what we call pure liquidation, because when a company goes into liquidation, everything needs to be sold off, it needs to be finalized, and you may not get the best value for the assets, or you may not be able to get the best return for creditors because you haven't got that time period. And then there's also another thing which we'll talk about in a little while later, called a small business reconstruction. And yeah, this came about for businesses roughly around about 2-3 years ago, 1st of January 2020, my memory serves me right, 2021. It took a while for that to sort of gain traction, and at the moment it is probably something which is quite becoming more and more common. What it really means is that it's for a small business. And when we say a small business, we're talking about total debts being less than $1 million. It's about the company and the directors making sure they haven't done an SBR, or a small business reconstruction, in the last 7 years, or they haven't done a simplified liquidation. All their lodgements are up to speed, and they don't actually owe any employee entitlements. They've all been paid. But in many ways, what we're probably seeing is that it's for a smaller business which probably has tax debt, and they're struggling to make that tax debt, and there might be reasons why it has happened. It could have been due to COVID, or it could have been due to changing business circumstances, and it's like a voluntary administration, but a cheaper and a quicker way for smaller businesses. And the idea is creditors will then, there's set time periods and a process, but creditors then can have a vote on that, and if majority of in value, in other words in debt, agree to that, well then you could see potentially where they might compromise the debt for 20 or 30 cents on the dollar, and the business continues trading. So I've probably covered Insolvency Law 101 in about 5 minutes, but hopefully that gives people a bit of an overview of the different options out there. Thanks, Arlene.
We'll touch back on that small business reconstruction as well. I was learning that myself recently, because one of my clients was in that position and kind of working through it. So definitely we'll come back to that. There's also a question from the audience about a 3-way forecasting. We're going to touch on that a bit later on as well. So I will ask one of the panelists to address that later on. One of the things, I guess, so Shannon, obviously you mentioned about kind of personal insolvency. Andrew, you touch on more on the, I guess, on the corporate or company side of things. But in a way, they're, directors and business owners that are part of a company, they have legal obligations as well. So what are they, and when the company's having or facing financial difficulties, what are the legal obligations of those directors?
Thanks, Arlene. So the main one is not to trade while insolvent. I think that's probably the one that everyone's most aware of. So when a company is facing financial difficulties, directors should ensure that they're not incurring debts while insolvent, or not incurring debts which will result in the company becoming insolvent. Andrew's already touched on the definition of being insolvent, which is effectively not being solvent. So not being able to pay your debts as and when they fall due. Directors have a duty to prevent insolvent trading. If they have concerns as to the solvency of their business, they should seek the appropriate guidance and advice. This will enable them to maximise the options available and to limit their personal exposure for insolvent trading. In order to reduce the risk of unknowingly insolvent trading while insolvent, directors should be understanding the company's financial position, making the appropriate inquiries, keeping up to date with tax obligations, monitoring cash flow, avoiding taking on too much debt, and seeking professional advice as soon as possible. So regardless of the financial position of the business, I just wanted to touch on as well that directors should always be mindful of their obligations to the company, ensuring that they continue to act with care and diligence, in good faith, and don't use their position to gain advantage or cause detriment to the company.
And that probably ties in really well with one of the questions that we had, which was, and we mentioned it as well before, about a three-way cash flow forecast. Gavin, do you have a favorite in terms of a three-way cash flow forecast?
Yeah, I think we've used a number of tools at RSM. So Spotlight is probably a favorite of mine. I think the most important is making sure it links up to your data file. So if we're rolling zero, for example, Spotlight will link up and pull real-time data. So as long as you spend the time up front to set your budgets, link the Spotlight software to your Xero, it pulls real-time data so you can check how you're tracking monthly. We've had many examples where we have bank covenants, and in years gone by when we're using Excel spreadsheets, we have to do a lot of rework on an ongoing basis, end up just paying advisors too much. But in reality, yeah, we spend the time to set things up properly, and just continually pull that data out. So at the touch of a button, business owners can see how they're stacking on profit, balance sheet, and cash flow.
And can you just touch on then, Gav, about, you're doing all those cash flow planning. Part of it surely helps in terms of that managing the company tax debt and hopefully avoiding the individual or the directors themselves being personally liable for the tax debt. Can you elaborate a little bit more on that?
Yeah, so I think it's really good there, Shannon, talking about all the obligations of a director of a company. I think we've probably made an assumption there that our businesses are trading as a company. So first way to protect your personal liabilities is to get your structure right. If your business is trading as a partnership or as a sole trader, for example, you're personally on the hook for most debts anyway. So really, if we get the structure right in the first instance, to trade through a company with limited liability, we can limit your personal exposure through good practices and good habits. It gives you the opportunity to anyway. And I suppose, it's never too late to look at that structure. If you've got concerns, we've got a number of tools in tax land to make sure that can happen effectively, and we can achieve that commercial outcome. So once that structure is right and fit for purpose, and assuming we're trading through a company, keeping ATO lodgements up to date is probably one of the main things to keep personal liability at bay. So directors can be personally liable for late lodged GST, PAYG, and definitely super. So really, common misconception, if they don't click the lodge button, the ATO is not going to know what debts are sitting there and not going to come chasing them. I've heard this so many times before, but you're just making it infinitely worse. Getting a real-time view of your debts, your financial position, and your solvency. Shannon touched on don't trade while insolvent. Well, best way to do that is to know whether you are or not, whether you can pay these debts is so important after the fact. If you do have to go down a liquidation process or something like that, that you can contain those debts, say to the ATO, for example, to the company. So I think that is a key takeaway, to just keep those lodgements up to date, and really setting up a company it creates a separate legal entity. It limits your personal liability. So we want to keep your personal finances and the company separate. So a lot of people will try and get a tax advantage. So they'll make money inside the company, strip out all the cash, go buy a nice boat or something like this, and then owe the company back money, right? And they don't want to pay tax at that top marginal tax rate. So they might enter into what's known as a Division 7A loan, minimum repayments over a number of years. Good for an upfront tax advantage, but it ultimately puts your personal assets at risk because you owe the company money. So if someone like Andrew, for example, is appointed by the ATO to come and liquidate the company, first thing Andrew does, I'm assuming Andrew is control the assets. Big assets sitting there being director's loan. It just opens up so many more assets to get higher cents on the dollar for creditors. So keeping things separate is very important. And I think this common misconception that getting that upfront tax advantage on a Div 7A loan is a good thing. Yeah, I'll be reconsidering those strategies from an asset protection perspective.
And
It's
Arlene,
also not taxing guys. Go ahead.
just on Gavin's point is
Thanks, Al.
it's a really those Division 7A loans, they absolutely if you look at doing a small business reconstruction, the ATO and the creditors are really looking at that, and it's getting harder and harder to probably get a successful SBR up if you have those loans. So I didn't mean to interrupt everyone, but it's a really important point. It's what you leave today and defer today can bite you tomorrow.
Absolutely.
And maybe, Andrew, since you're talking about SBR, we might as well touch on SBR, but I do want to cover off director penalty notices just so that the attendees are aware also, because it kind of touches on what Gavin mentioned before around making sure your PAYG and super are up to date as much as you're separating your personal and the company, for example. The ATO are honing into the obligations of PAYG for your employees, really, when PAYG and SGC. But SBR, can we just touch on that very quickly, Andrew, if you don't mind, and what you've seen, how you've seen it work in practice, and what sort of the benefits are?
Yes, look, I'll be honest, we're being touch wood, our success rate's 100% at the moment. We had another one accepted on Friday, which we were a bit surprised in a nice way. I suppose what we're seeing at the moment is a lot of SBRs have been driven by, and we'll touch on a little bit later, director penalty notices and the ATO action. So that's probably bringing the small business sector or the small enterprises to look at their situation, and predominantly, whether it's fair or not fair, it's predominantly the ATO is probably the biggest creditor on most of the SBRs we're seeing. And there's reasons probably why, because of COVID and as Nick said previously, the ATO during COVID and the last few years probably wasn't as proactive and was probably a lot more conciliatory than what they are now. Very quickly, some of the SBRs we've done have been a lot of times not just driven by director penalty notice, not all of them. There have been one-offs or might have been reasons. For an example, is we did one for an SBR because it was a transport business. The director had died. The estate was going to probably be insolvent, and there was some life insurance proceeds to come in, and there was some debts in the company, and they decided to bring some of that life insurance proceeds over and compromise the debt of the company so it didn't become an insolvent estate. So that's one example. One which we worked very, very hard on and was successful as of Friday, because the voting finished, was a trading enterprise, a professional service firm. But the reason why an SBR was more appropriate was liquidation or administration. There was a very unknown quantity whether the license and how that person derived their income as a business would be able to trade. But the advice, the legal advice they got was under an SBR. They were able to trade and therefore could work through that. So that's a big reason why we did an SBR there. Another example where we've had is that obviously you've had an ongoing debt of ATO, but it was because not just for COVID, but it was impacted by sales reducing. They had there was some structural reform happening in their industry, and what has now happened is that they recognised that they needed to change how they were delivering their product and their services, and an SBR needed to be drawn a line in the sand to compromise the debt for them to be able to move forward with a restructure. And that's another type of SBR we've used. So I'm probably keeping it high level than going into the detail, but there's some of the reasons why we've seen SBRs work, and they've been very successful.
And that goes to your point before, in that like some of these options are available to businesses that will then allow them to continue as well trading after that has been dealt with under the SBR. Would that be fair to say?
Out of the SBRs we've done, most of them is because they want to continue trading. So yes, so it's about what we've found is continue trading, do a restructure because there's been a major thing happen, and how can they actually do better? And part of the SBR process is we have to work very closely with, which we're happy to do, with the advisors and the accountants, because you've got to do cash flows. You've actually got to demonstrate that an SBR is actually viable, and these you have potentially up to 3 years for a plan to be successful. Generally, what we're seeing is most of the time, creditors are probably preferring to see a lump sum payment, a relatively short period of time, because the longer that plan is in place, there's more risks that things could go wrong. And thirdly, that they'd like to obviously see that there's something in place that if hypothetically, if it's ATO debt, that they're going to continue lodging their returns, they're going to continue paying their returns, they're going to be a good corporate citizen.
And to answer one of the questions as well, RSM do provide clients with a 3-way forecast. That's something that Gavin and Nick and regularly help their clients with, and people in business advisory. And to Andrew's point, also working with other divisions such as the R&R division in working through SBR, for example. And just in the kind of final minutes, Shannon, could you just give us a quick overview of direct penalty notice, which we touched on very briefly, just for the benefit of the attendees, and then I will close as well after that.
Sure. Thanks, Eileen. So as Gavin noted, directors can become personally liable for companies' unpaid PAYG, GST and super. This is known as director penalties, and it's a parallel liability. The ATO can seek to recover these director penalties after they have issued something called a director penalty notice. Now, it's really important to note that this notice looks very similar to standard ATO correspondence. It's not something that doesn't come in red paper, and often we see that it can potentially be ignored or put to the side to be dealt with in due course. If one of these is received, it really needs to be actioned immediately. This gives the business the best chance of moving forward, and also avoiding that personal liability for the company's debts. There's 2 types of DPNs. There's non-lockdown DPNs and lockdown DPNs. The non-lockdown ones are when the reporting is done GST PAYG within 3 months after the due date, and SGC reporting within the due date. Lockdown is when they're not done within those timeframes. For non-lockdown DPNs, the letter will go out and it'll allow within 21 days, the penalty will be remitted if either an administrator is appointed, the debt is paid in full, a SBR is appointed, or the company is wound up. Now, that obviously gives directors options before they become personally liable for debt. And this is one of the reasons why Gavin was saying it's so important to be getting your lodgements up to date, because if you receive a lockdown DPN, so if those reportings haven't been done, you are personally liable for that debt. The only way to remit it is if the debt is paid in full. So there's no options. There's no 21-day option. And that 21-day is set in stone, and it's from the date of the letter. So that's why I say it's so critical to be responding immediately, getting advice immediately to make sure that you are giving yourself the best chance of avoiding that personal liability.
Thanks, Shannon, and thank you for giving us a quick overview of the DPN. I think we've covered a lot of grounds today in today's webinar. I'd like to thank all four of you for your time and also sharing insights. I'd like to thank everybody as well for joining and being an active participant, asking questions. Really appreciate if you can take a few seconds to complete a brief survey. The link will be in the chat box shortly. And if you'd like to revisit any of the content covered today, we'll be sending you a link to the recording. And then as well as if you haven't accessed the Think Big report on this topic, another link will also be on the chat box. So download the report. And you'll find there as well some information about this Business Essentials series, where each month we look at different topics of interest to business owners. So a couple of things, final parting words, considerations and strategies. Regularly seek advice on your business performance so you can make that agile and real-time decision making. Be on the lookout for indicators of financial distress, and when they are identified, early engagement with advisors are crucial. And make sure that ongoing compliance with tax reporting, because what you do want to avoid is those director penalty notices. If you do get one, seek advice immediately. So I trust the Business Essentials series, and in particular today's webinar, has been very beneficial for those of you here today. And yeah, I look forward to seeing you at the next webinar. Have a great afternoon, everybody.